Hi, everyone. Good afternoon. Thank you so much for joining the South African Chamber this evening as we're going to have a fun-filled discussion about taxes. I'm just waiting for a few more people to join the call. Now 6:05. Give it one more minute, and then we'll start. We are in for a fun-filled session today. We've put a lot of work into the content that we're going to be discussing. And if I can get my words out, then I think you'll all enjoy it as well. Right, so let me share screen here. Okay. Okay, it's 6:06 and time to kick off. So good evening, everyone. For those of you who don't know me, my name is Michael Booth, and I have been involved in running the South African Chamber of Commerce now for over 3 years. We've gone from strength to strength, working through a pandemic and shifting fully to a digital initiative. But now that the pandemic's over, we're doing a lot more in-person and interactive events. So please do watch for our emails about events and get involved. Always good to get the community together to meet and network, build relationships. That's really what the Chamber of Commerce is about. So the topic of discussion here today is the 2023 budget. And so we've put together a summary of it and how it will be affecting South Africans who are abroad. So mainly people who are out in Singapore or out further afield, wherever you may be. We'll be looking at the topics that are, affecting you. So further to this, we'll be going into kind of a summary of ceasing your South African tax residency and the process involved with that and how it's changed under the new budget. There's been a few minor changes that they've introduced, and we're going to be talking about that. And yeah, so this evening I'm joined by Mariska de Bruin. Mariska, if you can just come on and say hi.
Hi, Michael.
Hey, Mariska. So Mariska, would you mind introducing yourself to our audience here this evening?
Yes, hi everyone. So I'm Mariska de Bruin from Mint Accounting. I'm a tax advisor and I basically specialize in non-resident and international tax.
Awesome. Mariska is also very humble. She has been really involved with the Chamber for the last 2 years, hosting these discussions with me. And the main purpose of these discussions and why we put them together is, number one, to give value to the community here in Singapore, and also to take fear out of, what we're seeing in marketing from other tax advisory firms offshore, basically helping people just to see the facts for the facts, and not to be pressured into, making decisions based off of fear mongering that you see in the media. So myself, Michael, I work for St. James's Place, and I specialize in helping South Africans navigate the financial waters of living offshore, be that through tax planning with Mariska or estate planning, where we look at drawing wills in multiple jurisdictions, to managing your assets offshore, investing the proceeds of your retirement funds coming out of South Africa, investing some of your surplus income here in Singapore, and then also helping you kind of look at your overall financial planning strategy and maximizing your opportunities while you're in Singapore, low tax jurisdiction, while also making sure that you're safe from an insurance point of view and, like I said, a will point of view. So that's me. So without further ado, I think we'll get into it. What we're going to cover this evening is going to be a summary of the 2023 budget speech. And basically, it's just a one page. There were a lot of things that were changed, but we focused in only on the pieces that are going to affect you offshore here. And please, as we're going, if there are any other nuances in the budget speech that you have seen in the media, please do put them in the chat, and we can try and explain those to you in simple terms. Basically, we have focused on the left-hand side pieces that have come into play for this budget speech, and then on the right-hand side, some proposed amendments that will be coming into play in the coming years. These have not yet been passed, but they've been proposed. So once we've covered this, we'll be moving into ceasing residency and how that has changed after the budget speech as well. So Mariska, over to you. What are your high-level summary out of the budget speech? What are your takeaways?
Okay, so for me, important was the fact that the retirement benefit lump sum tables had a threshold, and there was a raised by 10%, which just means that you're going to pay slightly less tax on your retirement annuities. And then also transfer pricing on the purchase of property, that's also been increased by 10%. So it also is beneficial to non-residents also buying property in South Africa. And then a big one is obviously we've got this electricity crisis where they've given us a little bit of an incentive for solar. So there's always been Section 12B that gave an allowance to businesses where you get up to 100% of the cost of your renewable energy assets. You can deduct that in the year of purchasing that. So they've done a temporary acceleration to that where you can now get 125% of that, and that is going to be for a period of 2 years, so from the 1st of March. So businesses obviously just get like an incentive. Then for individuals, this is a new one, and it's only for 12 months from the 1st of March. So basically for this tax year that we are in now, they've given you a rooftop solar panel incentive. So you can get up to 25% of the cost of your solar panels. You can deduct that from your tax. It is limited to 15%. So basically how it works is you'll do your tax calculation, and then there'll be your tax payable, and then this is actually a deduction from your tax payable. So it's not just the deduction before you arrive at your tax. If you need to pay 20,000 Rand tax and your cost goes to the limit of 15,000, you'll only end up paying 5,000 Rand tax. So it is an incentive, and also it could be an incentive and beneficial to non-residents as well, because there are still non-residents who own property in South Africa and who are renting it out. Or maybe you've got a property on Airbnb and you want to spoil your guest with power, then you can actually make use of this solar panel incentive.
Yeah.
I think what we can take from this is obviously that the electricity crisis is not going to be over soon. So there's like a little bit of a silver lining around this, but is it really?
Yeah, and also what Mariska highlighted to me while we were preparing for this is on rooftop solar panels only. So it's not in the whole renewable energy kind of transition, because if you going off grid, it's solar panels, inverters, the whole installation process. And this is a rebate essentially only for the solar panels. And if you look at the overall cost of going completely off the grid or installing a solar panel with inverter, you're looking at over 150,000 Rand. So, I mean, it's something that it's a drop in the ocean, really. Yeah.
Yeah, I feel like they had to put something in there. So we've got that now. Okay, so I'm going to move along to the increase on the tax tables. That's been increased by 4.9%, which it's not really in line with inflation, but across the board, they've given 4.9% increase. And then a new one that was proposed last year and it's been passed now and it's in effect from this tax year is that when you earn interest from a South African source, there's rebates available if there's up to 23,800, and then if you're over 75, it's 34,500 Rand. That rebate has now there's an apportionment on it. So if you cease tax residency and your year of assessment is then less than 12 months, then there's an apportionment on that. So if you, for instance, leave and you've only been a resident for 8 months, your year of assessment ends on that date, and there's a new year of assessment that starts for the non-resident you on the next date or day. So then your interest rebate of 23,800 Rand will be apportioned for that year. So you might end up paying a little bit more interest on or tax on your interest for that year. And then quite a big one that's come in now, it's also been proposed last year and it's in working now, is that there's a new two-part retirement savings system that is from the 1st of March that's in working now. So everything that you've contributed and saved up to now is in your vested pot, and that's invested there, and none of those rules change. So the same rules that ever existed for your pension, provident preservation, and retirement annuity, that's untouched. So nothing changes there. But then there's an unvested part that from the 1st of March 2023, all your contributions and growth goes into that pot. And that pot is also split into two, where you've got a savings pot and you've got a retirement pot. In your savings pot, 1/3 of your contributions will be put into this pot, and you can access those funds throughout the year. So your minimum requirement of withdrawal is 2,000 Rand, and you can withdraw up to whatever is in your savings pot, and you can only withdraw once in 12 months. So if you, for example, withdraw in April, then your 12 months will be finished next year, March, and then you can withdraw from your savings again. Yeah. Then your other pot is your retirement pot. So 2/3 of your contributions and growth will go into that pot, and that's then accessible at the age of 55 when you retire.
Yeah, so it might sound quite complicated what they've introduced here, but when you look at it on the screen here, you might also think that, oh wow, it looks like they've now given me, taken my one retirement plan and turned it into 4 pots underlying each with individual rules, and that's complicated. It's really simple. There is the large amount of your pension that you've saved up over the years is going to be in the unvested portion. Going forward, any amounts contributed or any amounts that are going to get growth, those are going to be in the vested account. And then within the vested, there's an amount you can access every 12 months. And then there's a large amount, 2/3 of it, which you can't access until age 55. So if anything, it's given you more access to some of your investment products than you would have had initially. So it is a good thing, but for us who are sitting here offshore, who are looking to bring these pension funds offshore eventually, there is no difference to us as immigrants. After 3 years of being offshore, you're qualified to pull your retirement annuities out of the country. So it might sound complex, but it's not. So Mariska, I think what you mentioned earlier about the interest rebate is interesting. And that kind of brings us to the proposed amendments that they're making. And well, they haven't been passed yet. What are your thoughts about these proposals that they've made?
Yeah, so the proposals that they've made, I feel like it's to bring it in line with the interest rebate that they are going to apportion when you cease tax residency. And the one is a proposal on your tax-free investment. So the rules on that is that throughout your lifetime, you can save up to 500,000 Rand, which will be tax-free. All your earnings and withdrawals of it is tax-free, but you can only contribute 36,000 Rand a year. Now, where I feel this is going to become a little bit complicated is that if you go over your 36,000 Rand for the year, or eventually over your 500,000 Rand in your lifetime, there's quite a hefty penalty on that because you've gone over it. So I see that the issue that could come in here is that if many people, they don't do a monthly contribution at the beginning of the year, they would contribute 36,000 Rand into their tax-free investment. If they then cease tax residency, for example, in November, and the apportionment comes in, what then happens to them? Will they then be penalized? So I do think in the consultations that they'll be having, they might iron out some of these issues, or there's going to be certain rules that will come in. But for now, this is what they've proposed, and it's a little complicated. So that's the one for the tax-free investment. And then also all the contributions that you make to your retirement products, you get a contribution deduction every year. They are also proposing to apportion this in your year where your assessment is shorter than 12 months. And the current deduction is limited to 350,000 Rand or 27.5% of your remuneration or taxable income. So that also just will be apportioned. And then whatever value is not allowed in that tax year, it would go to your new retirement pot. So you don't lose it, it's just not deductible in that tax year.
Yeah, and also, so what we mean when we're saying it's going to be apportioned, if we just break it up into simple terms, I live in South Africa, I move overseas, I'm now living in Singapore. During that year of assessment, I did contribute to my retirement annuities. Instead of me getting a full year's deduction for those contributions, it will be apportioned for the time that I did spend in South Africa as tax resident and in that year of assessment. And when I cease residency, if it's 8 months out of 12 months of the year, that means that is the amount that would be tax deductible. Any other additional amount would not be. So instead of you getting the full year's tax deduction, now it's going to be the period that you were actually tax resident for that year of assessment before going offshore. So, you know, obviously this hasn't come into play. It is a bit confusing, as Mariska says, and we're yet to hear consultations on how they want to how they want to apply this to the new pot system they've just introduced. No doubt there are going to be tax notes released on this and how it works. And so, you know, when this does get introduced, perhaps in the next year's budget, we'll be able to update you guys again on how this is going to work. But when we talk about the intention behind the changes in the budget, and Mariska and I were looking at this and discussing, saying, you know, what is the intention for bringing these sort of apportionments into play? My personal opinion is that it's because they are trying to limit the amount of tax deductibility that you could have in your given year of assessment when you cease tax residency, to maximize their tax revenue for that given period. Mariska, would you agree, or do you have an opposing view?
I agree. I think I definitely agree with you. I don't think there's another reason.
So on that note, the other big thing outside of what we have discussed here, that's obviously been in the media, everyone's had a look at grey listing. Now, I'm not sure if everyone understands what grey listing means, but essentially what that means is now that your country is put onto a watch list because they don't meet crime fighting, anti-money laundering, anti-terrorism laws globally. And they could be seen as a higher risk jurisdiction for those reasons, for money laundering, terrorism, etc. So obviously, if you are a person who is looking to cease your tax residency, you're a South African passport holder, you're looking to bring your assets offshore, and you go through the process, say with Mariska, grey listing could have an impact on you. Mariska, in your view, how do you think grey listing is going to affect you guys?
Yeah, so what I've discussed with the intermediaries that I work with is that nothing with the banks, they haven't really released anything yet, but what it will entail is more due diligence in their onboarding processes, is just to make sure that the person that they are onboarding is legitimate. There will be more FICA happening, and what they have indicated to me is that from April they have to actually upload the client's FICA to the bank, and that's only certain banks that has indicated that. But as far as, you know, new rules or whatever, the bank has not yet fully said what they are going to do, but mainly it's going to be more due diligence and just making sure that the risk rating of this person is not high.
Yeah. And so that's on the South African side. If you're looking at moving funds offshore, you're going through the process, getting tax clearances, opening bank accounts, get the money offshore. That's coming out of South Africa. On this side in Singapore, basically what I've seen within my own compliance team and within other product providers within Singapore is any South African passport holders that want to open new accounts, new investments, insurances, etc., there will be enhanced due diligence on them simply because they're South African passport holders. This enhanced due diligence is basically, instead of just being able to provide proof of address and your passport, it would be further to that. It would be, what is the source of the funds? Were taxes paid on this? So tax clearance certificates. How did the money get from, say, South Africa to here? Is there a remittance transaction record for us to have a look at? All of that sort of thing. So basically, the grey listing has put us in the same bucket as countries like Syria and Nigeria. And what that means for you as a South African living offshore is, should you want to do anything in a financial institution, it might become a bit more tricky. Simply even opening a bank account or a trading account or investment account, etc. So absolutely going to affect you. So I'm seeing we're getting a few questions here in the chat. Let me just have a look here. Okay, so one of the first questions, Christian, we will come to it. That is going to be in the next section that we're going to talk to in a moment. We'll have the answer for that here. And I'm getting feedback here. So basically, in terms of the grey listing and how it has affected some South Africans, Adrian says, I've received numerous requests from Singapore finance institutions to complete checks on myself as an individual, all within the last week, as I have existing investments that have been settled in Singapore for a number of years, but they're still asking for due diligence now. Please, guys, you expect this. It's going to come. So no other questions regarding the summary for the budget. So we'll move on into ceasing residency, background, reasons why, you know, it could be in your interest to do so. Mariska and I have helped a number of our clients jointly in figuring out how to approach this. So basically tying up tax affairs in South Africa, helping you to understand kind of the whole process from that side, and then getting your money out of South Africa safely. And then once it's here, we talk about obviously how to deploy it into market, you know, how best to manage it from a Singapore point of view for tax planning this side. So Mariska, could you give us a high-level overview on why ceasing residence is important for South Africans who are offshore?
Yes. Okay. So I'll start with the Tax Administration Act. Basically, like you're obligated to do it. So as per the Tax Administration Act, whenever your registered particulars change, let that be your address, you need to inform SARS of that fact within 21 business days. And that includes your physical address and your resident status change. So it's really an obligation, but so few people are aware of that. And what a lot of people also feel like is when they emigrate that they are immigrants and they don't have to do anything with SARS, but immigrating from South Africa doesn't automatically make you a non-resident. It just means that you're a South African resident living temporarily abroad. And where that then comes in is that South Africans pay tax or need to declare their worldwide income and assets to SARS, where non-resident taxpayers only need to declare their South African source-based income. So it's beneficial to you to actually just break your tie. So it's beneficial and it's an obligation to actually seize your tax residency.
And guys, there's a difference between an obligation and a requirement. Generally, if you say that you're obliged to do something, it means that, you know, you don't have to, but you should. A requirement is you must. But in this case, you're obligated to do so not to satisfy the tax authorities, but just for your own protection, rather. So in terms of this, you know, it was introduced in the 1st of March 2020. We've all heard about it. We've seen it in the media. We've heard about a foreign employment income exemption. You know, if I earn more than 1.25 million rand, and I could be liable to tax in South Africa, and we should all be worried. There's been a lot of fear mongering about that in the news over the last 3 years. So there's a couple misconceptions about how this exemption works. Mariska, could you give us a bit of an overview and your thoughts on this?
Yeah, so the misconception is that if I earn below 1.25 million Rand, I don't need to inform SARS. All my income will anyway be exempt. So I'm just going to go with that. Or that I'm going to just go with the double tax agreement. Unfortunately, there's just so much misinformation in the market and tax advice or people advising expats wrong. So the main takeaway of this exemption is that it is only available to South African tax residents. So the starting point of this is, have you moved overseas? So you've physically packed up and you've moved overseas. If that has happened, you need to look at a tax treaty. So the double tax agreement that we have with that country, and a tax treaty would stipulate how you would become an exclusive tax resident of that country. When you meet the requirements of a tax treaty, the tax treaty actually overrides the Income Tax Act and any tax rules. So that takes preference. If you're an exclusive tax resident of another country because of the tax treaty, then you're not a South African tax resident anymore, and this exemption does not apply to you. So you do not get the first 1.25 million Rand exempt. So the requirements for this exemption is obviously to be a tax resident, and then you must be in an employment contract relationship. You can't be a subcontractor or a freelancer. And also you must spend more than 183 days outside of South Africa, which should be 60 days, should be consecutive. If you meet those rules, and this would really be for someone who maybe still lives in South Africa, but they have maybe they go on a short contract in Singapore, they don't meet the tax treaty rules, they come back and forth, maybe, work a little bit in Singapore and a little bit in South Africa, or maybe someone who works offshore. This is really for who that is. It's not for someone who has emigrated and fully packed up. So just on this requirement, obviously, if you are one of those people who are just temporarily there and you do meet the requirements, you can get the 1.25 million Rand tax free. So for example, if you earn 2 million Rand, then your first 1.25 million Rand will be exempt, and your 750,000 Rand is then taxable in South Africa. Because of the double tax agreement, there's also another relief available, and that's the Section 6 quat foreign tax credit available. So if you did pay tax on that income in another country, then that will be a credit for you in South Africa. So it's not always to say that you are going to pay a high tax rate in South Africa. If you pay tax already, that is going to be a credit. So there are reliefs available. Then the other relief is obviously the main relief, which is the double tax agreement that we have. And the reason for that is just because this agreement allows taxing rights in one of the countries, and it's always to do with your physical presence. And if you're mostly present in another country, then you are using their resources, which means all of your income is their source-based income, and you are going to be taxable in that country. So the main takeaway here is just that it's important to understand if you are permanently overseas or if you're temporarily there, if you meet the tax treaty rules, and then does this apply to you or not?
Yeah, absolutely. So like Mariska was saying here, this is extremely important if you are going to be moving overseas permanently, and you want to kind of cut your ties with South Africa, ensure that you're not going to be subject to taxation ever again, it might be useful to explore this option. If you are not sure, you want to be offshore kind of 3 to 5 years, build a nest egg here in Singapore, go back to South Africa, that's when a tax treaty, double tax agreement could play into your favor and support you. In Singapore, the maximum tax rate that you would be kind of looking at is 22%. So if you are in a high earning tax bracket here, once you do the conversion at the current exchange rate of over 13.6 to the Rand, to the Singapore dollar, sorry, what that could mean is that if you are earning above $400,000 a year, there is a chance that the amount that you earn, which is capped at, say, the amount that you're taxed in Singapore is, say, 22%, the amount you're taxed in South Africa is 45%, net the 1.25 million, there is a chance that you could still pay tax in South Africa or have a tax liability. The double tax agreement is there to protect you, but if you are intending to be offshore for a very long time, or not intending to go back, it is definitely worth exploring getting rid of your South African tax residency, and what that could mean.
Yes.
So going into double tax agreement, Singapore tax treaty, Mariska, give us your view on that.
Yeah, so each country has their own set of unique rules of how you would become an exclusive tax resident of that country. And Singapore's rules just looks at, there's two tests that you can look at. So you would look at the individual, and the quantitative test is all to do with your presence there. How much time do you spend there? So it would first be that you are physically present in Singapore for at least 183 days in the calendar year preceding the year of assessment, or that you exercise employment in Singapore for at least 183 days in the calendar year preceding the year of assessment. This does not include directors. So it's basically that you have to be physically present in Singapore for at least 183 days in the previous year, or you were exercising employment there for 183 days. So it could actually be very easy for you to meet that requirement. And I think something that could sometimes happen is that you have no intention to always live there, but because of the tax treaty, maybe you go on a 2-year contract, that does actually make you a tax resident of Singapore, whether or not you are planning to move there forever. If you meet the requirements, that does override everything. The qualitative test is not to do with your physical presence, but it's more of if you have a residence in Singapore. So if you permanently reside in Singapore and your absence from Singapore is just temporary and reasonable. So you could become a tax resident for either of those reasons.
So again, you only have to satisfy one of these tests, not both.
Yes.
Okay. So one of the questions we have got about this is, how do you define exercise and employment? So for example, if you are a director of a company and work for the company, is that what this is referring to? It says excluding directors of the company. So
yeah, so I think it's because generally directors do not exercise employment. They fall in a different category. So if they are physically present in Singapore for 183 days, they would still meet the test.
Okay. And if they're not, they're exercising their duties as a director from outside the country, then they wouldn't meet the quantitative test because they're not in the country for 183 days.
Correct, yes, but then it could become a little bit complicated where place of effective management could come in, so being a director of a global company, that does put you in such a more complicated situation. So it's always advisable to seek advice on this, because you could be in another country but a director of a foreign country, and that could make you a tax resident at least for a part of your earnings in that country.
And then again, from a South African point of view, they would also look, where's your most fixed and settled place of residence, where's the place you're most likely to return to, all those things, and then they would weigh up the case of whether or not you are actually tax resident according to the treaty. But I mean, that then comes into the next piece about the double tax agreement, right?
Yes, the tiebreaker clause.
Yeah. So would you mind just explaining to everyone how a tiebreaker clause works and when it's enacted?
Yes. So all the double tax agreements that we have with the countries, the format is generally set out in the same way, and all of them have an Article 4, which relates to residence. Certain countries obviously have their own set of rules, but the tiebreaker clause is always the same. And what you look at here is that if it is not determined in the tax treaty or very easily that you are a tax resident of that country, we would go to the tiebreaker clause. And what the first step that we look in, and also what's very important to note here, is that you do not need to meet all these tests. Again, it's like whichever one you meet first. So if you meet the first test, you don't even have to look at the rest of it. You become a tax resident or you don't. Okay. So the first test is that where is your permanent home available to you? So that would be if you've packed up and moved to Singapore and you're renting a property there, that is a permanent home. Then you would look at South Africa. Do you have a permanent home available in South Africa? So most people who immigrate, they sell their properties and they go to Singapore. So that's an easy one for them. They've got no property in South Africa. But certain people would keep their property in South Africa for investment purposes, or perhaps they are trying to sell it so it's on the market. Then you look at that. Is for you to have a permanent home in South Africa, you must physically be able to get on a plane, fly to South Africa, walk into that house, and you can live there. That's what your permanent home is. If you just have a property that is rented out, so you've got a contract where it's rented out to a non-connected person, or perhaps it's on Airbnb permanently, or maybe it's in the process of being sold, you've got a contract with an estate agent and your furniture is not in the house, so it's not livable basically, then it's not a permanent home. So then if you have that situation and you're living in Singapore, then you meet the test of having a permanent home there, and you won't need to look any further. Let's say that someone has a holiday home in South Africa that's always available to them. That would obviously could be a permanent home. If you're renting it out part-time, you would look at what percentage of the year is it available to you versus being rented out. And generally in tax, we look at being the majority of the time is more than 51%. So you'll just have to look at what period of time it's available to you. So if you can't determine it by this test, then we would go to the next one, which is where's your center of vital interest. And your center of vital interest just mean basically where are you building your life? Is that in Singapore where you've emigrated, you've taken your wife and your kids with, your kids are going to school in Singapore, you've taken up employment in Singapore, you are building your life where you have gym contracts and subscriptions, and you building your community in Singapore. If it's stronger in that country than it is in South Africa, then your center of vital interest is in that country. Where it could be that you still have a center of vital interest in South Africa is if you've left quite a few things here. Maybe you've got lots of properties, investments, your pension, all of that is still here. Then you would go to your habitual abode, and your habitual abode is basically just the place where you rest and recoup the most. And there's not a definite period what you would look at, but we could look at a period of 5 years. In the last 5 years, where did you rest and recoup the most? If it's still not you can't determine that between the two countries, you would look at where are you a national, and that could determine you. So I think this is where digital nomads sometimes can walk into a brick wall, because you're a national of some country, so that could definitely make you a tax resident. And if you're a national of both countries, that can obviously not be determined, then the tax authorities of those countries would then decide where you are a tax resident.
And again, this is a double tax agreement, which would apply if you are a tax resident in South Africa and a tax resident in Singapore. If you haven't ceased your residence, you can enact a double tax agreement. You go through this whole process to see whether or not it applies to you. And yeah, so again, only if you are a tax resident of South Africa and there is a potential tax liability in that country would you enact a double tax agreement. If that doesn't apply to you, then it's okay. So moving on, there were a few changes that came into play to immigration last year and last year's budget. So this was where they announced it in March 21, but they've only really come into play this year properly with the kind of the vested, unvested parts of the retirement account and that sort of thing. So the process that's involved with ceasing your residence has changed somewhat, but not by much. Mariska, you want to give us an overview?
Yeah, so even though this has changed years ago, people still refer to financial immigration. And also I do find that there are still a lot of confusion in the market about this. And I find that some people sometimes say to me, no, I don't want to financially emigrate. I just want to seize my tax residency. So what has changed in this process is that financial immigration phased out. What financial immigration really was, is it was a reserve bank process. It's the only thing that SARS really had to do with it is that you needed a tax clearance certificate to give to the Reserve Bank so that they can be satisfied that you can financially immigrate. So the Reserve Bank is not involved anymore. You did apply for an immigration tax clearance certificate, and then you could immediately withdraw your retirement annuity fund in the past. You also had to close all your bank accounts once you had that status of immigrant. You had to close your bank accounts, and you could only have a blocked bank account. So you didn't have any control over your money, and that was just from a safety point of view, that everything had to be placed on record with the Reserve Bank. Then also, if you had no more remaining assets or income in South Africa, you could then deregister your tax number, and that's where the whole SARS process came in. So what has changed now is that the Reserve Bank is not, you don't report through the Reserve Bank anymore. The applications go through SARS, and I'll explain later on how exactly the application is done and what is involved. And then you can still withdraw from your retirement annuity, but you have to wait 3 years. You have to be a non-resident for 3 consecutive years. So that was quite a big change that happened. And then you do need to inform your bank accounts that your bank that you are a non-resident, but it's not a blocked account anymore. So you have somewhat control over your bank, and that is that you have, like, certain banks could give you certain transactional access, but we'll discuss that a bit later as well. And then also, everyone has a single discretionary allowance where you can send funds abroad up to 1 million rand, and you don't need a tax clearance certificate for this. So non-residents who cease their tax residency still have access to this 1 million rand. The only time that falls away is if you have applied for an immigration tax clearance certificate. So you've got that immigration TCS PIN. That then changes your status with the Reserve Bank. When you have that PIN, the Reserve Bank then sees you as an immigrant, and then you're not allowed to send your 1 million rand abroad or use your 1 million rand anymore. What is then available to you is you can apply for a foreign investment tax clearance certificate for up to 10 million rand, or you can apply for a special approval for an amount between 10 million and then up to 20 million rand. It's the same process. It's a foreign tax clearance certificate. It's just that it goes through a little bit more due diligence because of the value that's involved. So you don't lose all your function of sending money abroad. It just could be that you lose your 1 million rand.
So some of the most important pieces with what Mariska has just explained there is a lot of this was just a change in terminology. And then the reason the terminology has changed is because it's been a change in process. Financial immigration is a thing of the past. It's been phased out. It was a South African Reserve Bank process. That process has now been brought into South African Revenue Services, and hence you are not financially immigrating. You are doing your tax migration. You are simply ceasing tax residence. So change of terminology. And then again, the connotation with a blocked bank account is that it was blocked. You could, once your money was in there, its sole purpose was to leave the country, and you could not do any functionality with it. Now there's limited function with it, and it is not called a blocked account. It's called a non-resident account. So again, it all comes back to the question of, once you have started ceasing your tax residency, do you have things that you need to pay for in South Africa still, or do you not? If the answer is no, then a simple non-resident account, with limited transaction services is not the end of the world for you, because the sole process is to get the money out of the country. If you do have debit orders for, supporting parents or paying for property or doing that sort of thing, you can work with a treasury intermediary, and they will basically run your debit orders for you off of the non-resident account. So yeah, just change of terminology here. And it's been a good change. I think there's a lot of fear mongering that was involved with the financial immigration. So yeah, I don't see it as a bad thing. So in terms of how do you cease residency, like what is the actual process? Something that came up in last year's budget, and in the previous year they were discussing it was, okay, there's now going to be on your tax return, there's going to be a little box you can tick if you've ceased tax residency in that year of assessment. It lasted less than 12 months and it's now gone because it triggered so many automatic audits that I think obviously SARS was bombarded. So that's now gone. So Mariska, now that that's changed, what is the process going forward to actually cease your residency?
Yeah, okay, so Michael, I agree with you that it's much better now. And the reason for that is just it's more systematic and you actually get an outcome from SARS now, where before you never had that proof. I like to call it their breakup letter with you. You did not have the proof of that breakup letter that they had. So the steps that you are going to do now is that you will change your status with SARS, and it's an online process. We facilitate the entire process. So everything that I'm going to explain now, we facilitate the process for you. So it's an online process of updating your registered particulars, and then you would do step 2. It automatically goes to step 2, where SARS then opens a link where you then need to provide them with your cease to be resident declaration and with very specific documents that need to be added with that. And the documents are like your passport exit stamp and the visa obtained of how you were allowed to enter that country. And then lots of things about what you have left in South Africa. Did your family move with you? We do a motivation letter just to explain to them why you cease tax residency, and then also a tax residency certificate from your country of residence. That's quite an important one. And I wonder, Michael, if you just maybe want to explain to them, especially in Singapore, how you apply for this.
Yeah, so your certificates of tax residency in Singapore is actually quite easy to obtain. So you log into your online tax portal here, which is on IRIS's website. And then you can go and write them a message. So you go into your normal portal, write to them, and it will come up with an automated kind of, information box where you can kind of write to them. You just select your tax residency or your status in Singapore as a foreigner. Then you choose what are you writing about, which is certificate of residence. Then you put in the block, I would like to have a letter for certificate of residence for all the years of assessment that I have been resident in Singapore. And then there is a Excel spreadsheet that you have to manually complete for each year of assessment that you've been here. You then take all of those and you attach it to this text box that I'm talking about. You click submit, and kind of depending on how busy they are and what time of year it is, it could be anywhere from 2 to 6 weeks that it would take for you to physically get the letters. And also they would email them to you in the same IRIS portal. They become available. Something to note, they do disappear. So if they are in your IRIS tax portal and they have issued it to you, please download it and save it, because if you don't, they're only there in the portal for a limited period of time. I think it's up to 2 or 3 months, and then it's gone and you have to go through the whole palaver again. So please do save it.
Thank you, Michael.
Sure.
Okay, so then once you have all those documents and we submit that application to SARS, it's 21 business days, so basically a month, for them just to work through everything and approve your application. And then if they accept it, they then issue you with your notice of non-resident status, so your breakup letter. And that is, there's no time limit on it. Once they've issued you with this, you're a non-resident, and that's your proof, which you should keep, because there's certain times and certain transactions that you're going to do in the future that you might need this document. Okay, so if you do not qualify yet to withdraw your retirement annuity fund, so you haven't been a non-resident for 3 consecutive years, your next step would then be just to submit your tax return to declare any earnings that you had of a South African source, because remember, now you're a non-resident, so only your South African source-based income is taxable in South Africa. Perhaps it was that you ceased tax residency in this tax year, so you have 2 years of assessment where you were a resident, and then there's and then the next tax year starts. So it just depends on where you are in the process of when you've left. So you might then, at this stage, your next step would be to submit a tax return And just important to note that this tax return, sometimes when you submit your tax return, immediately you get an assessment. But because you've now ceased tax residency and SARS automatically ticked your box that you've ceased tax residency, there could be a manual intervention that happens, and that takes up to 90 business days, which is quite a long time for your return to be assessed. So just note that it might just cause a few delays because of the nature of your return. And the main thing in this is that when you cease tax residency, there's a capital gains tax that's payable that I will explain more about later. But that is then what goes into this tax return, is you need to declare any capital gains tax. And if it is that you were perhaps, you ceased tax residency 5 years ago and you weren't aware of the fact that you had to pay capital gains tax, you can apply for a voluntary disclosure application, and then SARS might waive your understatement penalties. And I say might, I haven't had a decline yet, but I mean, so it's always up to SARS 200% if they feel that there were that you had gross negligence in not declaring that. But majority of the case, that is not the case. So your step 3 could be a tax return, but it could also be that you're in a different stage of your immigration process, which would then take us to step number 4, which is if you have immigrated more than 3 years ago, your steps would be to change your status, do your cease to be resident declaration, and then your next step would be that we would apply for an immigration tax clearance PIN. And we really only ever apply for this PIN if you've got your retirement annuity that you want to withdraw, because that's one of the requirements to withdraw your retirement annuity. If you had liquid funds at the time of immigrating, you would do that on a foreign investment tax clearance or on your SDAs. So do the immigration tax clearance PIN, and then after that we facilitate the process with the fund house where we would help you to withdraw that. And that entails it's a 4 to 6 week process as well. It's quite long because the fund would need to check all your requirements, they disinvest the policy, and then they apply for a tax directive from SARS, which sometimes it's such a mission to get, especially with when the whole process moved over. Sometimes we get declines because the cease to be resident declaration has not been approved, but then we're like, but SARS, you are sitting with the application, why don't you know about this? So it's just sometimes very hard to get around SARS. So sometimes there's delays when it comes to this step, but majority of the time it could be between 4 to 6 weeks. And then in this process as well is when you need to apply for or open a non-resident bank account, because the fund house won't pay your funds into any other bank account. You have to have a non-resident bank account. Then we would also facilitate that process of informing the fund of your non-resident bank account, and they will pay it to your non-resident account. And then you can liaise with your Forex intermediary on when you want the funds to be sent abroad. It is just very important in the process of waiting to qualify. So let's say you did not yet make your 3 years and you are in year 1, so you immigrated last year and you're waiting for your 3 years to pass. It's very important throughout that period to keep your tax returns compliant, because we have found that even though you've immigrated, you've told SARS, they've given you the letter, and they know that you're a non-resident and you earn no South African source-based income, really all you have left is your RA. We have unfortunately found that SARS still then issues admin penalties because you haven't submitted your tax return. And this is such a process because the admin penalty can be anything between 250 Rand and it can go up to 16,000 Rand depending on what your earnings were. And that's a monthly penalty. So if you don't submit your tax return, it's a 250 Rand every month, and SARS is not going to stop that until you submit that tax return, so become compliant, and then you've got the penalty, and you've got one of 2 options. Either we can dispute the penalty for you and say, SARS, this person was not supposed to submit a tax return, or you can just pay the penalty. And in most cases, our fees are more expensive than for disputing the admin penalty than just paying the 250 Rand. But you don't want to just unnecessarily be giving money away. So the most cost-effective way is just until your retirement annuity has been paid out, just submit 0 returns if you didn't earn anything in South Africa.
Yeah, so just on this, guys, so what we're discussing here, there's 2 tracks of ceasing residency, right? Okay, so there's the track of I have been out of the country for more than 3 years consecutively, I qualify to remove my retirement accounts already at the time that I'm ceasing my residency. And then there's the other track of I've been out of the country for less than 3 consecutive years. I do not qualify to pull my retirement annuities out. If you are in the camp of I have not been out of the country for 3 consecutive years, that is when this applies to you, where during that waiting until you have been abroad 3 years, you have to submit a nil tax return every year, or else you're going to have the issues that Mariska is explaining. If you have been out of the country for 3 years or more, much more simplified. It's a streamlined process, and you're gonna get it done. So let's just assume now that you are in the waiting process to have your 3 consecutive years. You have to wait until you've had it. Only at that point can you deregister your tax number, and you have to submit your tax returns for that waiting period until that 3 consecutive year mark has been reached. If not, and you have been out of the country for more than 3 years, very simplified, 4 to 6 weeks to get your funds from the retirement company, from the investment house into your non-resident bank account. And then from there to get it offshore is another few weeks and it's gone. Thereafter, we get to the last point, which is I've done it personally. It's quite satisfying to know that I don't have a tax number anymore in South Africa. So yeah.
Yeah, it's just as satisfying to me receiving letters for people who we have submitted the deregistrations for. That is the last step in the process. So if you have no more income or assets left in South Africa, you can actually deregister your tax number. And this process, it's just so unpredictable. We can't tell you how long it's going to take. Sometimes we submit it and we get it within a month, and sometimes we've waited up to 2 years for SARS to do it. So it's really, the first 5 steps can take up to 4 months. So this is now considering you've been out for 3 years, you're qualified for your RA. That process can take up to 4 months, and that is the whole process. Then we wait for the tax season to open next year. We submit your final tax return to tell SARS you've taken your RA, and then we start with a deregistration process. And then that process can take up to 18 months. So we do work with you for quite a long period of time, but after 4 months, you're a non-resident, you've taken your RA out, your money is out, you're now just waiting for the final steps. If you have your RA to withdraw, it could be, that we work with you for 2 years, 3 years, 4 years. It's a long relationship.
Yeah. So again, 2 tracks here for ceasing residency. So guys, I know we've come on to the hour here. It's now just hit 7 o'clock. The last piece that's incredibly important is if you do cease residency, what are the consequences? What triggers? What happens if you do cease tax residency at that point? And Christian, this comes to your question you asked earlier. So please, Mariska, if you could unpack this for us.
Okay, so the main consequence is the trigger of exit tax that everyone hears in the media about. And exit tax is basically just capital gains tax. And there's a deemed disposal of your worldwide assets when you cease tax residency. So in simple terms, it's the resident you selling your assets to the non-resident you. So you don't physically have to sell your assets. And there's certain assets that's excluded from this deemed sale. So anything that you own worldwide would be included, apart from if you have immovable property in South Africa, because you'll only pay this capital gains tax in the future when you actually sell your property. Non-residents and residents pay the same capital gains tax, so that's excluded. Then also certain shares that you have in private companies, and also certain employment equity instruments, but everything else that you own. So for example, if you have shares listed on the JSE or foreign shares, unit trust, if you have foreign properties, if you have certain interest in trust or private companies, all of that could attract capital gains tax. And you don't have to sell it, but the proceeds in your capital gains tax calculation will be what is the market value of those assets on the date that you cease tax residency. So those are the important things that we would look at in calculating this for you.
So again, guys, it means a deemed disposal, where they look at it and they say you have been deemed to have disposed of the assets. which means you don't actually sell them. It's just what is their actual market value today, and they'll use that to calculate the deemed capital gains tax that you will be liable for. And again, Mariska, correct me if I'm wrong, but that tax liability would then only be payable when you do dispose of the assets in the future. Is that correct?
So is that of the property?
No, of any other assets outside of a movable property. So if I have investments that are wherever, I would be deemed to have disposed of them, even if I haven't sold them. And then at the point that I do actually sell them in the future, I will have to pay capital gains tax from the value at the time I cease residence.
No. So the reason why there's this deemed sale of your property is because non-residents don't pay capital gains tax on all assets in South Africa. The only property is basically fixed assets, fixed property. So if like non-residents don't pay capital gains tax on shares in South Africa. So if you pay your capital gains tax when you cease, then and you keep your shares, you're not going to pay capital gains tax on the sale of those shares in the future. So that's excluded. The only thing that would happen for you is if you still earn interest or dividends from those shares, that's from a South African source, and that will be included in your income tax. But no CGT on the future sale of your shares or your foreign assets at all. It's only just your fixed property.
Understood. Got you.
Another important factor that I have to bring up, and this happens quite a lot, is that you have a family trust and your family trust owns properties and you know everything that you've built up with your family. If you have vested rights in this trust at the date of ceasing tax residency, that means that you've got a right to the assets of this trust, and that's going to be included in your capital gains tax calculation when you cease tax residency. Another important thing to note, and the reason why most people set up these trusts is to keep their property safe. But then when you sell your property while you are a tax resident, you do a flow-through process where the trust sells the property, but because you're the beneficiary, the trust would distribute the sale of that property to you, and you are going to pay capital gains tax at 18%. But there's an anti-avoidance rule in the Income Tax Act that says that where a distribution of a capital nature is made to a non-resident, it's taxable in the hands of the resident. So what happens here basically is that if the trust sells that property, that flow through can't happen to you as a non-resident anymore. The trust will pay the capital gains tax at 36% because that's the trust's effective tax rate on capital gains tax. So if you are in the fortunate position where you have not yet emigrated, you can do tax planning and set your trust up in a way where perhaps it vests to you while you are a resident and you can pay the capital gains tax. So planning ahead of emigrating is very important. But if you haven't planned and you ceased many years ago, then unfortunately your property in your trust would attract tax at 36%.
Very clear, thank you. So everyone, the last piece here that I'll just brush over quite quickly is if you are going to be pulling your retirement annuities out of South Africa, basically there's two tax tables that are applicable. One would be if you are over the age of 55, and that is for the value of from 550 onwards, there would be a tax payable on it. And then there is what's called the immigration or the withdrawal table. So it's very important to recognize here in South Africa that there are three different kinds of retirement vehicles that are available: retirement annuities, retirement or pension funds, and then provident funds. In between that, there's also what we call preservation funds that would fall into either pension or provident as preservation. Each of those have, excuse me, each of those have a different ruling when it comes to immigration in terms of how they are treated. Pension funds and retirement annuities, whether you are 55 or younger, they will be taxed at immigration on this because you are taking the full amount out, you being seen to be withdrawing it. If it's a provident fund and you're age 55 or over, there's a rule in provident funds that you are allowed to take one withdrawal of the full amount during your during the lifetime of the product. And that, if you are over 55, would be taxed at this table. Mariska, is there anything I missed out on that?
No, I think that's good. I think just the main thing to think about when you're a non-resident is, when are you going to withdraw? Do you want to do it on immigration and pay the higher tax, because then you're able to take the full lump sum out and nothing is left in South Africa? But if you are closer to retirement age, it might be more beneficial to look at the maturity way of withdrawing. But the one thing that you do need to keep in mind is that when you withdraw at maturity, only your 1/3 lump sum can be withdrawn if the value is below 247,500. If your value exceeds that, then you can only withdraw 1/3 lump sum, and then the other 2/3 need to go into a living annuity, which is in South Africa, which means that you still need to continue submitting tax returns to South Africa. You're subject to tax on that living annuity in South Africa. The double tax agreement allows for your country of residence to tax your pensions, actually. So that would be, let's say in Singapore, they have the first right to tax your pensions. Now you're paying tax there, also paying tax in South Africa. We can apply for a tax director from SARS to prove to them that you are paying tax in the other country. And then they would issue you with a tax director for the fund to withdraw 0%. So it's just a little bit of an admin burden. You have to do this every year. You have to submit your tax return every year. But if it is going to save you money because you're close to retirement age, it might be better to look at this option.
So this is an exercise that I work with Mariska in conjunction. And basically, we would look at the client's age, we look at the amount of money that they have in these different products, and then we'll look at what is the potential tax liability if they withdraw today versus if they wait until age 55. If they're 3 years away from retirement, we can look at it and kind of say, okay, if you take the hit today, this is the potential tax liability. This is the amount of money that you could look to get out. If we wait until 55, this is the difference. This is the amount that you could pay. The biggest one that this has an impact on is provident funds. Now, again, a big question of this is, what is the Rand going to be worth in 3 to 5 years? The devaluation of the Rand is also an additional factor in line with taxation that you have to look at. So basically, yes, I take the hit today, but I get my money out at the current rate of exchange, or I wait and I perhaps take a lesser tax hit, but at that point in time, 3 to 5 years down the road, perhaps the value of the money after tax in real dollar terms is going to be less than if I had done it earlier, just through the devaluation of the Rand. So these are the conversations, and it's not a simple solution, because obviously there might be an emotional element to withdrawing your money here. You've worked 20 years to build this up, and now you're going to pay X amount of tax. It hurts. So looking at it in brass tax terms, where we look at, okay, cool, this is if you take it today, this is if you delay by 5 years, this is the tax liability, this is the potential devaluation of the Rand. Then you make an informed decision of, right, what do we do from here? So now, guys, we are running out of time, and there have been some good questions. So before we get into our frequently asked questions that we've been asked a lot, I thought that I will just answer some of the questions here. So Mariska, here's a question for someone who has, so if they are a British person and they live in South Africa for a number of years and they take up tax residency there and they're intending to go back there, but now they have gone off and they're living in Singapore on a shorter duration, call it a 4 to 5 year basis, and they cease residency, and then their intention is to go back to South Africa and to live and retire there. Is there a process that, so they cease their residency while they're offshore for this period of 5 years or whatever it is? When they go back to South Africa, if that happens within 5 years, is there negative impacts for doing so? And is there a process to uncease residence or take residency again in South Africa?
Yeah, so no, there's no, there's no negative effect on it. In the past, that used to be called the failed immigration, but you can do it easily now. So how I understand your question is that it was a British citizen who came to South Africa to become a tax resident here, and then they're leaving to Singapore. So for them, breaking tax residency is a bit different to ours. They don't need to meet the tax treaty rules. They just need to be outside of South Africa for 330 consecutive days. They break tax residency. Then when they come back, and this is actually for anyone who comes back, is that to become a tax resident again, you need to meet the physical presence test. So, you know, unless if you earn income here and all of that. So it's a fairly simple process. You come back, you inform SARS that I'm back, I'm a tax resident again, reinstate my tax number if it was deregistered. So there's no negative effect on doing that whole process of emigrating again.
Perfect. That answers the question very well. So then, guys, please, if there's any other questions that you might have after we've kind of got to this point here, please do pop them in the chat. So the next thing that I want to ask you about is on our next page, Mariska, is what if I cease residency and then I receive an inheritance in the future? How is that treated?
This is quite an important topic, and it's come up a lot over the last year, also because of the changes in how things in financial immigration. Is that there's one of two ways: is that if you have previously lived in South Africa and were a tax resident, so you've got a tax number, then you will need to prove to the Reserve Bank that you ceased tax residency. So you were registered for tax, you've been out even for 20 years. I've had cases like that. Someone's been out for 20 years. The Reserve Bank says, no, you were registered for tax. I want proof that you ceased tax residency. We then need to reinstate that tax number, go through the whole tax migration process just so that that person can take their inheritance out. So if you were registered for tax, you need to do a tax migration process, apply for a cease to be resident, apply for an immigration tax clearance certificate PIN, and then you can take your inheritance out. If you were never registered for tax because maybe you were a minor or you just never worked before you left South Africa, then you don't need to re-register a tax number. If the inheritance is below 10 million Rand, the Reserve Bank will allow it to go out. If it's above 10 million Rand, you would just apply for a manual letter of compliance from SARS, but you don't need to register a tax number or do a tax migration process.
Thank you. And for a lot of people, although the inheritance they might receive is not going to be much, it is still a consideration if you do intend to have that money come out of the country in the future. So everyone, I don't see any other questions in the chat here, and I did schedule this talk to be until 7:15 our time. Thank you, Mariska, for doing this in your morning. But guys, if you would like to talk to us further, if you'd like to engage and understand how this is going to be affecting you personally, obviously what we have discussed here is very blanket terms. It's very much just the facts. It's not personal advice. If you want to seek personal advice, Mariska's details are here. Very simply, mariska@mintaccounting.co.za, and the website www.mintaccounting.co.za. And as Mariska has said, she specializes in non-resident and international tax. Please visit their website. They've recently gone through a rebranding. It looks fantastic. And have a look. If you want to get in touch with me, please, my email address is michael.booth@sjpp.asia. So that's St. James's Place.asia. And I'll be happy to meet you for coffee, hear about your personal story coming from South Africa and what you're doing over here in Singapore. And I'll help you to navigate kind of financial waters out here as best I can. In terms of the chamber, as I said in the beginning, we're doing a lot of exciting events. Some of you attended our wine tasting that we did last year, guys. Thank you for your support. You did come. We're doing a lot more events like that coming up. At the end of April on Freedom Day, we're looking to do an event with the Swiss Chamber of Commerce at the Swiss Club. It's going to be very exciting, where we're going to be comparing Butterwurst with German Swiss sausage and South African wine with Swiss cheese. The Swiss ambassador is going to be there. It's going to be a really great evening. Please do stay tuned for some information on that. And just visit our website, www.sham.sg, to find out more about our events. Mariska, thank you very much for your time, your effort, and your energy that you put into this. I really appreciate all of your help.
You're welcome. Thank you, Michael. It's always nice doing this with you and working with you and everyone in Singapore as well.
Thanks so much. So guys, we'll leave it there for the evening. Enjoy the evening with your families, and thank you so much for your support. Please do reach out if you have any questions.